So,
All right. So you're welcome again to another class. Today we are going to continue from where we stopped last week, which is group account. Last week we are already consolidating and making a series of adjustments using the same principle of cancellation, where the focus was to cancel out similar items or similar transactions between the parent and the subsidiary, and any uncancelled out items should be cancelled out. It should be consolidated. And we did quite a number of questions last week, and we stopped at this place. We solved up to this question that has series of adjustments. And today now we're going to proceed from where we stopped. And it's still the same thing that we're going to do going forward. But we are going to look at some further intragroup transactions, how to cancel them out. And typically, the one we are going to look at for further similar transaction between the parents and the subsidiaries, because the whole idea of consolidation is we want to prepare the account to look as if it's that of a single entity. So any transactions between the two must be cancelled out. And today we are going to look at two types of transaction, then probably solve questions, is where there is intragroup sales of goods or of inventory, and also where there is intragroup sales of non-current assets. The principle is very clear here, right? For intragroup sales of inventory, is if the parent and the subsidiary sells goods to one another. If that sales to one another results in trade receivables and trade payables, I already told you that you cancel that one out. What I've not told you is this, which we have not got into. Number one is P&L. In P&L, you cancel it out also, because one will have recognized sales, while another one will recognize purchases or cost of sales. You cancel them out. But the thing is this, they might attempt to make profit from one another. The parent might sell to the subsidiary at a profit and vice versa. It's not possible for a single entity to make profit from itself. Such profit has to be eliminated. You remove it. You remove it. So if there is any profit between the two of them, eliminate it. I'll show you how that is done. Secondly, the same explanation applies to if they sell PPE or intangible asset amongst one another and they make profit. Reverse that profit from wherever it is hiding. Remove it. Just that when they sell non-current assets to one another, especially if it is a depreciable asset, so the guy that bought the assets, the party that bought the assets will have been depreciating the assets. And the base of that depreciation, which is his costs, he would have element of profit. He will have acquired it at the profit, and the depreciation will now be based on an amount that has profit load. And since we're going to cancel out that profit, that means he has over depreciated the asset. That means there will be excess depreciation. That excess depreciation also needs to be identified and cancelled out. That is it. That's basically what we want to consider first. So let's look at some questions, two or three questions to actually resolve that first before we go to some other parts. So let's start with this. This one says Pico has owned 75% of the shares of ESCO since the incorporation of ESCO. Now, say during the year to 31st December 2017, ESCO sold goods costing 8,000 to PICO at a price of 10,000. And these goods are still unsold by PICO at the end of the year. Summary of financial position of the two companies on 31st December 2017 are given below. So, and I say we are required to prepare consolidated statement of financial position of PICO. At 31st December 2017, the fair value of the NCI at acquisition was 12,500. Okay, so the major thing here was that they sold goods. ESCO sold goods to PICO, goods that cost 8,000, and he sold it at the price of 10,000, and these goods were still unsold at the end. So let's cancel that out. So my workings one first is this unrealized profits, because there is a profit that he has made, that ESCO has made of 10,000. So intra-group sales of goods resulting, there's an unrealized profit, which is 10,000 minus the cost of 8,000 of 2,000. Now, and this good were still unsold by PICO. It is still in the inventory of PICO. So you need to two adjustments. This profit, you deduct the unrealized profits, from the inventory of PICO, because it's still in the inventory of PICO. So you remove 2,000, and also, who is making the profits? ESCO, the seller. So you remove it from the retained earnings of ESCO, the same amount. You remove it from his retained earnings. And that's what you would do to this unrealized profit. You need to eliminate it. It should be eliminated. Good enough. Those are the only adjustments. Then we can do our normal cancellation. First is the one that will result in that goodwill. So we'll have consideration transferred. How much did the parents paid? He paid 37,500. Then non-controlling interests. The non-controlling interest is measured at fair value. They give us 12,500. So NCI 12,500. The addition of the two will give me how much? And this 50,000. We'll cancel that out against the net assets acquired at the date of acquisition, which is the same thing as equity of the subsidiary, which comprises the ordinary share capital. And what's the ordinary share capital of the subsidiary? 50,000. against the pre-acquisition retained earnings of the subsidiary, which is 30,000. No. Okay, he acquired IMSIS Incorporation. That means there is no reserve as at that date. That means there is no pre. There is no pre-acquisition retained earnings. And in this case, we don't even have any goodwill because it cancels out completely. And number 3, we have consolidated retained earnings. As per correction, this 75 and this 30. This 75 and this 30. Then group share in ESCO. The group has 75% of this 30,000. Anyone? How much would that give us?
$22,500.
What's the addition of the two?
$97,500.
Finally, non-controlling interest, value of NCI, computed it as 12.5 year. NCI share is 25% times this 30,000. How much does that give us?
$7,500.
7,500.
7,500.
Okay. So what's the addition? That's 20,000. Let's consolidate. What's the year end? 31st December. What was the first item here? The two gives me 122,500. Then the next item, which is my investment, that has been cancelled out and there was 0 goodwill. Then my current assets, I have my inventory. What's the addition of these two? It's 49,000. $49,000 minus the unrealized profits. that we say we remove from inventory, which is 2,000. Then we have trade receivables. This gives me 18,000. Let's add all together. What was the addition of everything?
$187,500.
My ordinary share capital. This is 40,000. Because this one has been cancelled out. I hope you will still remember that. Whatever balance is remaining is NCI. So this 40,000. Then my consolidated retained earnings. Okay. Note 4, note 3, 975. Then my NCI, 20,000. Say 20,000. Yeah. So what's the addition of all this? My equity.
$157,500.
Okay. Then my current liabilities is 32,000. So my total equity and liabilities gives me 187,500. So the only thing that is new in this question is this, how to treat this. That's the only thing. Every other thing is something we have looked at before. That's the only thing that is new here. How to remove this unrealized profit. Now moving on. Now this one states that Pico acquired 80% of the shares of ESCO on 4th January 2017 when the retained earnings of ESCO stood at 5,000. The statement of financial position of the two companies on 31st December 2017 are given below. We're given statement of financial position as at 31st December 2017. So they give us all this. And I told us that ESCO sold to Pico, sold goods to Pico for 25,000. The profit to ESCO being 20% of selling price. At the end of the reporting period, 7,500 of these goods remain unsold. At the same date, Pico owed 6,000 for goods bought, and this debt is included in the trade payables of Pico and receivables of ESCO. NCI is valued at 9,000 at the date of acquisition. prepare consolidation of financial position as at 31st December 2007. Okay, the only thing here is there is intergroup sales of goods and ESCO. Out of these sales, ESCO made a profit of 20% of selling price, and only 7,500 of these goods remain unsold. Okay. And additionally, there is 6,000 in their account. Let me check the 6,000. Okay, they didn't separate it. But I know that we need to eliminate this 6,000 from the payables and receivables of the two of them. We need to remember to do that, so otherwise we will lose some marks. Okay. So number one is that there is intra-group sales of goods, and ESCO sold to Pico. My concern is the unrealized profits. And the unrealized profits is 20%. If you do 20% of 25,000, you are wrong, right? Because out of these goods that is sold to one another, only 75 is still remain unsold. It's still within the group. That means Pico has sold those goods to other people outside of the group. That means that it's not the entire profit that is unrealized. There's a portion that is realized. So even though, yes, the original transaction happened between the two of them, but now that they have sold the good out of the group, then that profit becomes hand. The only portion of the profit that is on hand is to the extent of the goods that remain unsold, which is valued at 7,500. So to the portion of the goods that remain unsold. So the unrealized profit will be 20% of that. And what's 20% of 7,500?
1,500.
That's 1,500. And this 1,500, how do you treat it? You are going to deduct from inventory of Pico. Then you also deduct from retained earnings of ESCO. That's how you always treat it, depending on who is selling. Oh. I made a mistake here. Just remembered now. We removed from inventory. We didn't remove from retained earnings. Okay. So unrealized profits, that's from the last correction. We didn't remember to remove this 2,000. So that brings this one down to 28,000. That means what we are sharing. And I'm removing it from retained earnings of ESCO because it was ESCO that made the profits. So what is 75% of 28,000? And this 21,000. And this will give me 96,000. And this 25% of 28,000.
7,000.
This is 19,500. So this retained earnings will change to 96,000. While this one will change to 19,500. It should give us the same answer.
Does that mean that the account is not balanced or what, sir? Or the Yeah, I
Still,
thought we were supposed to have the same thing with the. Okay, we are having the same thing.
Not ba-
Abi, it's still balanced now.
That's what I'm saying. That since there is that mistake, why is it that the account balance? I don't understand.
Because it's affecting two
You didn't
legs.
balance. Check.
We only changed this one. This is 96,000. And this is how much? 19,500. It should still be the same thing. If we add these three together, what will it give us? 40,000 plus 96,000 plus 19,
155,500.
155,500. And what about this? Plus 32,000.
That's 187,500. 187,500.
How about,
It's correct. No?
no, wait, add this together.
187,500.
Okay, because even then, it's still balanced then because it should not even have balanced that time. I don't know. Because we removed it from inventory. We did not remove it from retained earnings. The account should not balance. We didn't add it very well.
Back. I was just waiting for you to finish to bring you back there. It's just only the second part is affected. You were having excess of 2,000.
Yes, yes, yes. Okay, so this one now, so this one, don't let us forget to treat it in the two. That's for the intragroup sales. Then the cancellation. What was the consideration transferred? How much did the parent pay?
23,000.
Pay 23. How was NCI measured?
Fair value.
How much did they give us as NCI?
9,000.
9,000. So the addition gives me what?
That's
That
2,000.
30,000. Then net asset acquired. What was my ordinary share capital? 15,000. 15,000. What was the pre-acquisition retained earnings?
5,000.
Okay. Where did you see that? Okay, up here. 5,000. So what's the addition of the two?
20,000.
So what's my goodwill?
12,000.
So my consolidated retained earnings. People. So as per the question, what's the retained earnings of Pico? 22,511,000. I will deduct pre-acquisition retained earnings. What's the pre-acquisition retained earnings?
5,000.
What's the post-acquisition retained earnings?
6,000.
And don't let us forget the unrealized profits. Who is making the profits? ESCO. So you remove 1.5 from his profits being unrealized. So he's left with how much? 4.5, which is what is left to share. So group share in ESCO, group is getting 75% times 4.5. How much does that give us? This 75% they have. No, it's 80%. Do 80% of 4.5.
3,000. 3,600.
So add it together to 22,500.
20, 26 26,100.
Okay. Then non-controlling interests. So what's the value of NCI?
And 9,000.
So what's NCI share? That's 20% times 4.5.
900.
900. 900.
Okay. So NCI is simply 9,900. Okay. First item is PPE, and this is giving us 60,000. After PPE, the investments, which we canceled out, we're having 12,000 as goodwill. Then current assets. How much is our current assets? That's 35,000. But don't forget to remove unrealized profits from that 1.5. This unrealized profits here. This 1.5 here. So it brings us down to how much? 33.5. What's my total assets? How much?
105,500.
Okay. Equity and liabilities. So what's my ordinary share capital? That's that of the parent, which is 50,000. What's the next item? Retained earnings. We already did the workings for that. So I have my consolidated retained earnings, which is workings 3, which is 26.1. Then non-controlling interests, which is workings 4, which is 9,009. Yeah, add these three together.
It is 6,000.
How much?
It's
How much?
6,000.
86.
Okay.
It's 6,000.
It is 6,000. Okay. Then my current liabilities, how much is that? This is 19.5.
19.5.
How much does this give us?
105,500.
Okay. So this is different. This is the same as the previous one. The only thing we are just learning here is this. The unrealized profits is to the extent of the unsold goods. Is to the extent of the unsold goods.
Okay, sir. What about this the remaining good that is still remaining? That's 6,000. How do we now? This 6,000 that is remaining.
Ah,
How do we treat it?
you're supposed to cancel it out now. They were owing one another
Oh,
6,000.
okay.
You're supposed to cancel out, remove 6,000 from here. If you remove 6,000 from here, what will remain? Is that not 27,500? And also, you're going to remove,
27,500.
okay, good. And you're going to remove the same 6,000 from here as well. So what will remain?
13,500.
So our final answer will change.
This is 60,000. 4,000. 99,500.
How about this?
Mm, 6,000.
995.
99,000. 99,500.
Okay. All right.
So, sir, what I understood by this thing is that if there is unrealized profit, we'll first remove it from the post-acquisition profit before we now share the balance. But if there is goods that is remaining, we'll remove it from current liability and current assets. Am I on the track, sir?
Not very well. So this 6,000 is not the goods remaining, no. It's the
Oh,
amount included in trade payables and trade receivables. Of course, it will have been from transactions between the two of them. So you cancel those ones out, just like we have explained before. For the unrealized profit, you remove it from the inventory of the guy that bought it. That's the profit element too. And also from the retained earnings of the guy making the profit. So, and the way you calculate the unrealized profit is you calculate the profit loading on any unsold goods. So even though they consummated 25,000 transactions between themselves, only 7,500 remain within the group. So the unrealized profit is to the extent of what has not been sold out, because that's the one that is unrealized. Because the one that they are sold out to other people, that means it's fine. That means they have made that transaction is now beyond the two of them. They have consummated transaction with parties outside of the group, which is okay. That kind of profit is the profit we want to recognize. Now the group has made profit. So these 75 that they have not been sold out, that's any profit loading on that eliminated, which is 20%. So that's really all. Okay, Lola, I can see your hand. You can ask your questions now.
Okay, good evening, sir. Good evening, everyone. So, sir, this is the question I have. I don't really understand the difference between the first question and this other question regarding the amount that was sold and the one that was unsold. That's my question. Thank
Yeah,
you.
so for this one, it's very clear. Difference is so clear. So this one, they consummated transaction between themselves, and all the goods were still unsold. All the goods were still unsold. So the profits of 2,000 should be eliminated. So the profit of 2,000 eliminated. And here they made the profit straightforward. The cost of the goods is 8,000, the selling price 10,000. So 2,000 profits, eliminate everything. This is more like what you find in the exam, where the profit will be expressed in percentage. And this is what they only give you selling price. They won't bother giving you the cost. So if you go and do 20% of this 25,000, you are wrong, because only 7,500 remain unsold. And it's on this is the goods that we have not sold out of the group that we need to eliminate profit on. Any profit on that should be eliminated, because we cannot make profit from ourselves. So since we have not sold this goods out of the group, whatever profit we have made from one another from that, we remove it. And which is why when we're adjusting it, you see that the guy keeping the inventory will remove the unrealized profit from his own inventory, so that the inventory is shown at cost. The party that is making the profit, which is the seller, it was Esco that sold, we remove the retained earnings from his own, the unrealized profit from his retained earnings as well, so that the unrealized profit is removed from his retained earnings, from his profit. So that's that.
All right. Thank you, sir.
You're welcome. Any other questions? Okay. Now, this one is talking about intragroup sales of non-current assets. And here they stated that Pico acquired 80% of the shares of ESCO on 4 January 2016, when the retained earnings of ESCO stood at 5,000. The similar financial position of the two companies on 31 December 2017 are given below. So they give us similar financial position of the two companies. And we're told that on 4 January 2007, ESCO sold plants costing 5,000 to Pico for 6,250. The group charged a depreciation of 10% on all non-current assets. And NCI is valued at 9,000 at the date of acquisition. Prepare consolidated estimate of financial position of PICO at 31st December 2017. Okay. So this one, they sold plants that was costing 5,000 to PICO for 6,250. And the group charge depreciation on all non-current assets. So NCI is valued at, okay, this is just sales of plant. Every other thing is the same. Yeah. So for this, there was intragroup sales of plants. Our concern is to remove the unrealized profits. Our concern is to remove the unrealized profit. I'm in class. Unrealized profits. And what's the unrealized profit here? 6,250 minus what? 5,000. And that's how much? 1,250. Because the cost of the plant was 5,000. And he sold it to PICO for 6,250. So he made a profit of 1,250. This profit, we're going to deduct it from the plant of PICO. So PICO is carrying the plant in his books at 6,250. We need to remove that profit element. They can't make profit from themselves. So we'll remove it. Also, we are also going to we'll deduct these unrealized profits from the retained earnings of ESCO. So ESCO made a profit because it was the one that sold. So we are removing these unrealized profits, from his retained earnings as well. Additionally, there is now excess depreciation. Because ordinarily, depreciation should be calculated on 5,000, but because PICO bought the asset at 6,250, he will have calculated depreciation on this 6,250. So he must have calculated depreciation to the extent of the profits, excess. So there's an excess depreciation of 125. If you don't understand this simple one, you can go the hard way, which is to look at, okay, this is depreciation that he charged, which is 10% times 6,250, which is to this depreciation he charged. But what you should have charged, a correct depreciation to be charged, what you should charge is actually 10% on the cost. Which is 500. So there's an excess depreciation. There's an excess depreciation of 625 times 500, which is 125. I strongly recommend this in the exam. So the excess depreciation will have been on the profit, the unrealized profit. Now, how do you remove this excess depreciation? Number one, since he has overcharged depreciation on plants, you are going to deduct the excess. In fact, let me not rewrite. Let me say deduct from plants. Sorry, are you deducting? He has over deducted already. So we are going to add back to plants because he has over deducted. He has deducted too much. So we add it back. And also, we're going to add back to the plant of Pico. And also, we're going to add back to the guy that made profit because he had over deducted expense. We're going to add it back to the retained earnings of ESCO as well. And that's that for that. Then we can do our cancellation. Okay, go ahead with your question, please.
Yes, this add back to retain earning of ESCO is where I'm getting confused.
Okay. I was confusing you there. Unmute. Let's stop. Say you're confused. What's confusing you?
He has sold this item and made profit.
Yes.
So are we adding adding it again? Is it not an excess profit to him?
Is this on profit? I said excess depreciation.
So
Depreciation is overcharged.
Uh,
It's
I
good.
have,
The
I
only
have a
thing, the only thing is okay.
my
Okay.
own question is that
Hold
since he
on.
has sold it,
Hold
is
on, please.
okay.
So I think who is with the asset now? Is Pico, Abi?
Yes.
Yeah, so it's Pico that is charging depreciation.
Thank you.
Yeah.
matters.
It's not actually profit though, it's excess depreciation.
That's what I want to say because ESCO does not have any business with that asset again. Yes.
Yes, he has sold it. So what's the consideration transferred? How much did he pay for these assets? 23,000. What was the non-controlling interest? How is it measured? 9,000. What was the addition of the two?
32.
32. You cut it off against the net asset acquired. You have ordinary share capital. How much is the ordinary share capital of ESCO? This 15,000. Pre-acquisition retained earnings, 5,000. Add the two together. That's 20,000. We have a goodwill of how much? 12. Then consolidated retained earnings of Pico and ESCO. As per the question,
22,500.
and 11,000, Abi.
Yes, sir.
Remove what?
Pre-acquisition 5,000.
Remaining how much?
6,000.
And the what? Don't forget to remove the what? Unrealized profits and sales of plants. Who sold the plants? the subsidiary. How much did he make? He made 1 to 50. Abi?
Yes.
Yeah. He made 1 to 50. Then also, excess depreciation. You said add it back to the retained earnings of Pico.
Yeah,
How much was
Pico.
it? 125. 125. So group share in ESCO. How many percent does the group has? 80%.
80%.
That's 80% times how much? What's the balance here? What's 6,000 minus 50?
4,750.
Okay.
4,750.
So how much does that give us?
3,008.
3,000. So let's add all together. 22.5 plus 125 plus 38.
26,425.
Okay. Non-controlling interests. What's the value of NCI? 9,000. So what's NCI share of the retained earnings? What was the addition?
950 plus 9,000. 9,950.
It's 2017 now. Yes. What was the first item here? PPE. You add it, give 60,000. Then what's the next item? Investments that has been cancelled out. Giving goodwill of 12,000 in workings 2. Then my current assets. What's the addition? 35,000. Okay. Now, here, don't forget this 60,000. You made some adjustment to plants. Number one, we deducted this profit from plants, which is 1 to 50. So minus 1 to 50 from workings 1. And also we added this 125 to plants. So what does it give us?
61,375.
Like 61. 60,000 minus.
Okay,
875.
minus. Oh, sorry. I had everything. So
875.
Okay. 58,875. So what's my total asset now?
One oh five six two five.
105, 875.
No,
875. Yes.
yes.
You give me wrong figure, our account will not balance. So no. So ordinary share capital of the parents, that of the subsidiary will have been cancelled out. This 50,000. Then consolidated retained earnings, which is working 3. And this is 26,425. And non-controlling interest. This working 4. And that is 9,950. What is the addition of everything?
$86,375.
Okay. Which other item do we have? Current liabilities, 19,500. What is the addition?
105, 875.
105,875. Okay, so you see that for sales of plants, as you are eliminating the unrealized profits, you have to also add back the excess depreciation as well. Those are the adjustments for this guy. Any question? Moving on. So now, this question is just to teach you a few things. We just teach you a few things. Now look at this question closely. You say Pico acquired 80% of the shares of ESCO on 1st April 2017. We're now told that on December 2016, ESCO account showed a share premium of 2,000 and retained earnings of 75. We're told that some of the financial position of the two companies on 31st December 2017 are given below. NCI should be valued at full value. The market price of the subsidiary shares was 3 naira prior to acquisition by the parent. I'm now asked to prepare consolidated estimate of financial position as at December 2017. You can tell me what's the issue here? . What's the issue here? Because I can see that we acquired the subsidiary on 1st of April 2017. Now gave me the reserves. Reserve as at December 2016. This and this. And I'm supposed to consolidate at the end. So what's happening here is that I actually acquired the subsidiary during the year. That's what's happening here. I acquired the subsidiary during the year. So the major challenge here is this. These retained earnings they gave me as at December 2016 is not going to help me when I want to cancel out this investment against the equity of ESCO at the date of acquisition. This will not help me because what I need is the equity of the subsidiary at these dates, at the date of acquisition. So I have to figure that out. How do I determine the equity of this guy at this date? So it's quite straightforward. Let me show you. So again, the major issue here is the cancellation thing. So what's the consideration transferred? The parents, he paid 25,000. What's the non-controlling interest? NCI is measured at full value, and NCI is 20%. How many shares does ESCO has? Who can tell me the number of shares ESCO has?
10,000.
It has
Correct.
50,000 shares, sir.
No, it's 10,000.
Hmm.
It's 10,000. 50,000 divided by 0.5. That's the number of shares ESCO has. So out of that 10,000 shares, NCI has 20% of it. That gives me 2,000 shares. So what's the share price of the subsidiary? It's 3 naira. So times 3, we should be looking at 6,000. We add these two together, we are looking at 31,000.
I think you
So,
wrote times 2.
oh, 3 times 3. Thank you. That is, yeah, it's correct. What is the ordinary share capital of the subsidiary? That's 5,000. Now, this is where we are going. The pre-acquisition, in this case now, there's pre-acquisition share premium and there's pre-acquisition retained earnings. Now, for the share premium, what I need is what's the share premium as at April? Now, the question gave me as at last year, the ending of last year or the beginning of this year. They said the share premium is 2,000. I can see that in the account, the share premium of the subsidiary hasn't changed. So it has been 2,000 all along. Even in April, it will have been 2,000. Since it's still the same 2,000 at the end. So that means that 2,000 as at December still persists. It was still what it is as at April. But the retained earnings, which was 7.5 in December, was at the end, retained earnings is already 7.5. That means it has increased by how much? By how much? It has increased by how much? From 7.5 to 19.5. That's how much?
By 12,000.
By 12,000.
12,000, yes.
Okay. So that means my retained earnings as at April is the 7.5 as at December last year. And I bought this guy in 1st of April. That's 3 months. 3 months. So that 12,000 for the year. I'll just take just 3 months of that 12,000 is the one relating from January to 1st of April. And that will give me my retained earnings, my pre-acquisition retained earnings as at April. So my pre-acquisition retained earnings at April 2017 is the retained earnings at 31st December, which is 7.5, plus the profit for the year, plus the profit for 3 months, which is 3/12 times 12,000. And I know you know that this 12,000, the way I got it is you need to establish what's the profit for the year, which is 19.5, the profit as a year end minus the opening profits. This is the profit for the year. Then I take profit for 3 months, which is profit from January till 1st of April, just so that I can get my pre. That's 3,000. So my pre-acquisition retained earnings simply 10,500. So I just have to work it out for you so you can see it clearly. And that's really thin here in this question. So don't just assume that whatever retained earnings they give you up here is totally pre. Yes, it's pre, but I need as at this date. So in addition to this, there's still a portion of the profit for the year that is also pre, which is the 3 months in the year, January to March. Okay. Yeah, please, you can ask your question.
Okay, sir. So hadn't been there is difference for the share premium. This is the same pattern we will need to follow.
Oh, definitely. Definitely.
Okay, sir.
Okay. So what's the addition of these three?
$17.5.
So what's my goodwill?
13.5.
So my consolidated retained earnings. As per my correction, what's my retained earnings? 20,019.5. All the pre-acquisition retained earnings. What is the difference? Group share. What's the addition of these two?
$27,200.
Okay. So what's the value of NCI? Got 6,000 up there. How much is that?
1,800.
The addition gives what?
7,800.
As a twin? What's the first item here? PPE. This gives us how much? 31,000. Then the next item, investments. Goodwill of 13.5. May you cancel out. Then, can you please add this one for me? Current assets. That's 64,000.
$64,000, sir.
Okay, what's my total assets?
$108,500.
What was the ordinary share capital? 50,000. After that, we have share premium. This 2,000 has been cancelled out, so we'll consolidate only 3.5. Then consolidated retained earnings, which is working 3. How much is that? 27.2. Then non-controlling interest, which is working 4. 7.8. So what's the addition of everything?
$88,500.
What's the current liabilities? $20,000. What's my equity?
108,500.
108,500. Okay. Any questions? Okay, moving on. This question, we have done something like this before, but this one just has some additional, just few things. It says Speaker acquired 80% of the ordinary shares of ESCO on 1st April 2017. At that date, the fair value of ESCO's non-current assets was 11,000 greater than their carrying amount, and the balance of retained earnings was 10.5. The statement of financial position of the two companies on 31st March 2018 are given below. NCI should be valued at full value, which was deemed to be 18,000 at the acquisition date. And then we're given this. Said if ESCO had revalued its non-current assets at 1st April 2017, an additional 1,500 will have been made to the depreciation charge for the year ended 31st March 2018. Prepare the consolidated statement of financial position of PICO at 31st March 2018. Okay. Now for this one, the only new thing here, there's no new thing here. I've done this for you before. And what's happening here is this. I acquired this subsidiary in April, which is the date of acquisition. And at that date, the fair value of ESCO's non-current asset was 11,500 greater than their carrying amount. So at the date of acquisition, we discovered a revaluation surplus. So how do we treat that revaluation surplus here? Is there anyone that can try? How do we treat it here? Nobody can try? Okay. So this revaluation surplus, it will be treated as, we need to add it to the carrying amount when we want to consolidate. And also the reserve will be a pre-acquisition reserve. I taught you something like that earlier on, where we discovered a brand name, where we place value on a brand name. So the same thing, we treated it as an intangible asset, and we treated the other leg as a pre-acquisition reserve. So it's the same thing here too. But here now, since this is an asset, I think they depreciate it. So they now say that if ESCO had revalued the non-current assets, an addition of 1.5 will have been made to depreciation charge for the year. So that means if we capitalize that 11.5 and add it to our asset, we also then deduct depreciation from that asset. And that's all we need to do. So valuation surplus on non-current assets of 11.5. Two things. We're going to add it to PP, and also add to pre-acquisition. You add to pre-acquisition retained earnings. And secondly, the depreciation that has not been charged. So for the depreciation that has not been charged, first, we are going to deduct from the PP. And how much was that depreciation again? It was 15. Deduct from PP, more we deduct from retained earnings. Who has the assets? Retained earnings of ESCO. So this is important. It's also ESCO that has the PP. And basically, that's the only thing here that is new. Every other thing is what we have been doing and doing and doing over and over again. So, cancellation. Consideration transferred, how much? 25,500. Non-controlling interests is at full value.
18,000.
10,000. So what's the addition of the two?
$43,500.
Okay. So what's the net asset acquired? What's the ordinary share capital of the subsidiary?
10,000.
What's the pre-acquisition retained earnings?
$10,500.
Yeah, 10,500. This one. What's the pre-acquisition? Evaluation surplus. 11,500. We add to this 11,500 here. So what's the addition of this 3? This correct? This correct? As per question, is 48 and 25. What's the pre-acquisition with
10,500.
what's the post-acquisition retained earnings? 10,000. Then deduct depreciation. It's 1.5 now. Yes, 1.5. What's the balance?
8,500.
Okay. What is the group share? What is his holding? 50%.
That's
So what
6,800.
was the addition of the two?
54,800.
Okay. So what's the value of NCI?
18,000.
Okay, 10,000. So NCI share in Escrow's profits. That's 20% times 8.5.
1,700.
What's the addition of the two?
19,700.
This is not December. I think it's March, something like that. Let me confirm. Yeah, March 2018. So what's my PP? Can you add this two for me?
$45,500.
Okay. Then we need to add this 11.5. We say add it to PP. This evaluation surplus. And also this depreciation deduct from PP minus 11.5 or 1.5. So what does that give us?
That's 55,500.
Then workings 2, goodwill 11.5. Then can you add these two together? 62.5, I guess. 62.5 current assets. So what's the addition of all this?
That is 129,500.
Now equities and liabilities. What's my ordinary share capital?
40,000.
40,000. I will add, what do we have? Retained earnings. I have my consolidated
48,000.
working what?
Um,
Workings 3, that's 54,800. Workings 3. Then non-controlling interest is 4, which is 19,700. So what's the total here? Can you please add it?
114,500.
Then current liabilities. Which is how much?
129,500. Current liability is 15,000, sir.
You sure?
Yes, sir.
Okay. Okay. Now, we then solve past corrections. From last diet corrections, I picked May 2024. This May 2020. Okay. I just picked the corrections on statement of financial position from all your past corrections. So we're going to solve this tomorrow. Depending, there are 3 questions here. If you can solve the 3, good for you. That means you'll have, it's good for you. If you cannot, then, and when you solve this, then if you have time, you can solve more. But this will be the end of statement of financial position. This is the one that actually takes time. The other ones, associates and P&L. So those ones will not take our time at all. Maybe one period each. We'll be done with those ones, and we'll be done with group account. So another thing that will take our time is if I want to solve past questions on those ones as well, then we'll then use another period again to solve past questions on them. But let's whatever it is that is worth doing at all is worth doing well. So let's end it well. So that we know that we have closed the chapter on group accounts very well. So next week we should be about rounding it up next week. Worst case, upper week we'll round it up. Tomorrow we're going to hold our Sunday class, which will be the final morning class. After tomorrow, we won't hold any morning class anymore. We could not finish last week, so we're going to finish that question on IAS 40. Then we'll look at IAS 20, borrowing costs. So government grants is very short. And also we'll look at IAS 23, borrowing costs. Then we know that we are done with that chapter. So what will be left with you guys is cash flows, ratio, EPS. Which one again? We'll look at, I think, sustainability reporting or something like that. So and also we need to solve questions on published. I need to solve past questions on published. So that's all we have left to do. So let's end tomorrow's class. Then from next week, we'll structure how our class is going to be, because next week is going to be October. Our Saturday classes in that October might be happening between 6 and 8. So it will be very close to FM. I think you guys usually have FM from 8:30. So, because I'll be getting home late, because I think we'll be starting case study classes from next week. So our classes might be between 6:30 and 8:30 from next weekend, just for us to round up. So that's it. I hope you guys are reading. We have covered so much. We'll be finishing group accounts next week. And after that, I think I'll be taking up cash flow. And I will use the whole weekend to do that so that I can practice a lot of questions with you guys, maybe 2 or 3 past questions. Then afterwards, I will do ratio. I also practice past questions. Another weekend for ratios. Afterwards, EPS. I'm going to practice past questions. So it's past question, another weekend for that. That's 3 weekends. Then afterwards, which one again? Then published. Another whole weekend for published, just to solve past questions on published. Then if there are any other revisions, any theoretical discussions we need to make, then we would also make time for that as well. So, but for now, you guys should take care of yourself. I'll see you guys tomorrow by 10:30. Thank you very much. Have a good one. Yes,
Sabi, I don't have access to the online classes. I
The
don't know if
videos?
it's uploaded on YouTube.
The videos?
This particular one, this class.
It will be uploaded mostly maybe tomorrow.
Okay, sir.
Yes.
All right. Thanks, sir.
All right.
Have a nice day.
Yeah.